Good morning, everyone. So, yesterday we finished question 1, which was a 50 mark from the AAA-mock in the revision revolution. Question 2, we finished the A part, and I said we will continue with the mock so that we are done with at least one complete mock. So, I think let's begin with that without wasting any further time. I will just share the screen with you. Okay, so that's a paper that we were doing. We finished the first question, which was a 50 marker. Then of the second question, we finished the A part. This question, we finished the A part. That is, we wrote about lease of testing equipment, legal claim, and asset impairment. So the A part is done. Now let's look at the B part. Comment on the ethical and professional issues raised in respect of the audit of Turner Company and recommend any actions to be taken by the audit firm. So let's read the B part first. Your client portfolio is an audit manager at Quorum and Company, also includes Turner Company, which is a listed financial institution offering loans and credit facilities to both commercial and retail customers. You have received an email from the audit supervisor who is currently supervising interim testing on systems and controls in relation to the audit for the year ending 31 October 2018. The email gives the following details for your consideration. One of the audit team members, Janet Stott, has provisionally agreed to take out a loan with Turner Company to finance the purchase of a domestic residence. The loan will be secured on the property, and the client's business manager has promised Janet that he will ensure that she gets the best deal which the bank can offer. The payroll manager at Turner Company has asked the audit supervisor if it would be possible for Quorum and Company to provide a member of staff on secondment to work in the payroll department. The payroll manager has struggled to recruit a new supervisor for the organization's main payroll system and wants to assign a qualified member of the audit firm's staff for an initial period of 6 months. You have to comment on the ethical and professional issues raised in respect of the audit of Turner Company and recommend actions to be taken by the audit firm. So let's answer that. We've also read what should have been done. So first one is the loan to the member of an audit team. So whenever you're giving loan to a member of the audit team, this loan is not under normal conditions because obviously that person is a member of the audit team. So then what happens? Then of this issue, what are the ethical requirements? Then there is one more issue, which is a temporary staff assignment. So the company is having staff shortage and just telling the auditor, can you provide me staff? But if the auditor provides the company with staff, it will become a self-review threat. And they want staff for 6 months. If it was a matter of 10 days, 12 days, 15 days, we could have agreed that. But 6 months is a really huge time. So then what are the ethical and professional issues because of this? We have to write that in detail. So the first matter we have is loan. So this is the B part of the answer, which Turner PLC. Ethical and professional issues and actions to be taken by the audit firm. So first issue we have here is loan to member of the audit team. So about that issue, according to ethical standards for auditors, a loan to a member of the audit team may create a threat to the auditor's independence if the loan is not made under normal lending conditions or normal lending procedures and terms and conditions a self-interest threat, because loan is a self-interest threat, so a self-interest threat would be created as a result of Janet Stott's financial interest in the audit client. Okay. The self-interest threat arises because of the potential personal benefit derived, which may motivate the audit team members to behave in a manner aimed at protecting that benefit. Okay. In addition, an intimidation threat to objectivity may arise where a loan is made from the audit client to a member of the audit team. The threat arises because of fear that the audit client may, for example, change the terms of the loan or recall the loan, thus influencing the behavior of the auditor. Okay, so this is one thing that happens regarding the loan to a member of the audit team. These threats to objectivity are normally considered to be so significant that no safeguards would reduce the threat to an acceptable level. Okay, and because of this, it follows therefore that in most cases the audit team member should not accept such a loan guarantee. However, the ethical standards states that a loan from an audit client which is a bank or similar institution to a member of the audit team which is made under normal business terms and conditions is acceptable. So if my client is a bank and loan is given by bank only, so if I'm taking a loan from my client who is a bank or any other financial institution, and if it is under normal trading conditions, then that is acceptable. Okay, examples of such loans include home mortgages, car loans, and credit card balances. Okay, then next we have is the temporary staff assignment, because they need staff also. So about the temporary staff assignment, what can you say? Again, the ethical standards for auditors states that the lending to staff, lending of staff to an audit client may create a self-review threat, as I told you, to auditors' independence. The self-review threat arises when an auditor reviews work which they themselves have previously performed. For example, if the external auditor is involved in the process of preparing the payroll figures for inclusion financial statements and then audits them. As a result, there is a risk that the auditor would not be sufficiently So basically what happens is the auditor would not be sufficiently objective in performing the audit and may fail to identify the shortcomings in their own work. In addition, a management threat may arise if the employee undertakes work which involves making judgments and taking decisions in relation to accounting for payroll, which are probably the responsibility of management. Such assistance can only therefore be given for a short period of time, and the audit firm's staff must not assume management responsibility. And must not be involved in any activities specifically prohibited. Okay. According to the ethical standards, a short period of time is generally expected to be, so they want it for 6 months, but what is a short period of time? No more than a small number of months. So I'd say days, like 1 month. The client has requested staff for 6 months. Which may be considered too long a period to avoid ethical threats from arising. Okay. Therefore, the audit manager should decline the proposed staff assignment in relation to payroll services explaining to the client the reasons why the ethical standards prohibits the provision of this service. Okay, so this is what your answer should ideally be for the B part. That is this, and for 8 marks, so 4 each. 4 for loan to a member of the audit team and 4 to temporary staff assignment. Okay. This is how it should look. Now we're going to do the third question. Now I want you all to read and go through the third question again. Start from the requirements, first part, and then read the question. This is the question. Please read through it. This is the forecast statement of P&L. These are the notes. Okay, so let's begin with that. First one, there is a first part. Explain the matters which should be considered by Janssen and Company before accepting the engagement to review and report on Narle Company's prospective financial information. Second, assuming Janssen and Company accepts the engagement, recommend the examination procedures to be performed in respect of Narle Company's forecast statement of P&L. And then this is the B part, which we'll read after that and solve the B question. So let's read the question first. So first, A part is they have asked matters to consider before accepting an engagement. So you are an audit manager of Janssen and Company, which offers a range of audit and other assurance services to its clients. One of your audit clients is Narle Company, which operates a commercially haulage company. Narle Company has been an audit client for the last 5 years and is currently planning a significant expansion of its operations in a new geographical area and jurisdiction. In order to finance the planned expansion, Narle Company needs funds to purchase additional heavy goods vehicles, expand its warehousing facilities, and recruit more drivers. The company is also planning a major advertising and marketing campaign targeted at potential customers in the new jurisdiction. Narle Company's finance director, Suzanne Seddon, has approached you to ask if your firm will provide a report on the prospective financial information which has been prepared in support of a loan application. The application is for a new long-term loan of $22 million for the company's current lender, which it intends to use exclusively to finance the planned expansion. The company currently has an existing long-term loan of $31 million from the same bank, which is redeemable in 5 years' time. Suzanne Seddon has provided you with the following extract from the prospective financial information, which will form part of the company's loan application. So this is the unaudited 20x8. This is 20x9 forecast that we're expecting, and this is 20y0 forecast. So revenue, cost of sale, admin expenses, operating finance, and these numbers are for the notes that are given below. So these are the notes. The first one is regarding revenue, second is cost of sales, third is admin, and fourth is finance. Revenue represents the amount derived from the provision of haulage services to commercial customers operating principally in their retail sector. Narle Company's board of directors believe that the trade in both its existing and new markets will experience significant growth over the next 2 years. Cost of sales comprises the cost of warehousing and distribution, including relevant staff costs, maintenance and repair of vehicles, and depreciation of property, equipment, and vehicles. Administrative expenses are mainly the cost of running Narle Company's central head office facility. Finance costs represent the cost of servicing long-term finance from Narle Company's bankers. Explain the matters which should be considered by Janssen and Company before accepting the engagement to review and report on Narle Company's prospective financial information. The first one is matters to be considered before accepting engagement. So what matters will you consider, and it is for how many marks? 6 marks. When considering acceptance of the engagement, to review Limited's prospective financial information, which is a short form, prospective financial information. Jansen and Company must consider whether it is ethically acceptable to perform the review. The review of PFI, which is prospective financial information, represents a non-assurance service providing this service in addition to the audit may create an advocacy threat. Okay, an advocacy threat arises when the auditor is asked to promote or represent their client in some way. In this situation, there is a risk of the auditor being seen to promote the interest of the client with a third party such as a bank, right? As a result, there is a danger that the auditor will be biased in favor of the client and therefore cannot be fully objective. Okay, that will be a problem. Accepting the engagement may also create a self-interest threat as a result of the auditor being perceived to have interest in the outcome of negotiations with a third party, and which may motivate the auditor to behave in order to protect that interest. Okay. Then a self-review threat may also arise because the negotiations may result in facts and amounts which will form part of the audited financial statements. As a result, the auditor will be auditing financial statements which in part at least represent work themselves have requested. Have performed. It follows that there is a risk that the auditor will not be sufficiently objective in performing the audit and may fail to identify any shortcomings in their own work. In the case of Narli company, the advocacy threat appears to be particularly significant as the audit firm could be seen to be promoting the interest of the audit client to the bank. The auditor should therefore only accept the engagement if adequate safeguards can be put in place to manage the threat independence, to an acceptable level. Potential safeguards might include the following. So what are the potential safeguards that you can exercise basically? The use of separate teams, of suitably experienced staff for the audit and review of the PFI. Then independent senior review of the PFI working papers. Then discussion of the potential ethical issues and threats to auditors' independence with those charged with governance at Marley Limited. It should be noted that, however, it would not be possible to manage a significant advocacy threat through such a safeguard. And in such a case, the appointment should not be accepted. Janssen and Company should also consider the following matters in making their acceptance decision. The intended use of the information. Example, whether it is solely for the purpose of the proposed loan finance, then whether the information will be for general or limited distribution, the auditor needs to consider who will receive the report and potentially rely upon it. Then the period covered by the information that is shorter term forecast are likely to be more reliable than projections over a longer period. Janssen and Company must consider whether the firm has sufficient staff available with the appropriate skills and experience to perform the review engagement in line with the client's required reporting deadlines. And overall, the auditor must assess the risks associated with the review engagement and should not accept an engagement when the assumptions are clearly unrealistic or when the auditor believes that the prospective financial information will be inappropriate for its intended use. This is what we can write in terms of matters to be considered before accepting an audit engagement. Second one we have is for 9 marks. Assuming Janssen and Company accepts the engagement. So despite of doing all of that, they accept the engagement. That is what you have to assume. Recommend the examining procedures to be performed in respect of Narle Company's financial forecast statement of P&L. So what are the examination procedures that you will perform? The second one we have is examination procedures to be performed. Okay. The examination procedures to be performed we can directly start. Why to simply waste time to write? So the first examination procedure is the arithmetic accuracy of the forecast statements of P&L should be confirmed. Then confirmation that the accounting policies used in the forecast statements are consistent with those used in the audited financial statements, and that they comply with IFRS standards. Then what else? Discuss the key assumptions which have been made by the client in the preparation of the forecast statements, with management assessing their reasonableness and consistency with the audit firm's cumulative knowledge and understanding of the client. Then review of market research documentation, in narrowly limited existing markets and new markets, and discuss it with management to assess whether the growth patterns being forecast represent reasonableness and realistic expectations. It's for 9 marks, so at least 9 points. 1, 2, 3, 4. Obtain copies of any new customer contracts for existing and new markets to confirm reasonableness of the projected growth in revenue. Obtain a written representation from management confirming the reasonableness and completeness of the assumptions they have made in preparing the forecast. Recalculation of depreciation to ensure the correct inclusion of depreciation. Two more. Recent utility bills should be inspected and an assessment of the reasonableness of forecast utility overheads should be performed. Then last, obtain a review of supporting documentation for existing loan agreements with the bank, as well as the draft documentation for the new loan, the forecast finance cost should be recalculated and agreed to the forecast statements. So that is with it. Then we do the B part, but for the B part you have to read the question first. So B part is here. Let's read the requirement. Comment on the quality of the planning and performance of the audit of Watson Company, discussing the quality control and other professional issues raised. One of your colleagues at Jensen & Company, Rodney Evans, has been taken ill at short notice, and you have temporarily assigned as the audit manager of Watson Company, an IT consultancy company which is listed on a second-tier investment market. The final audit of Watson Company for the year ended 30th June 2018 is approaching completion, and you are in the process of reviewing the audit working papers. The draft financial statements for the year recognize profit before taxation for the year of $54.2 million and total assets of $23.1 million. The audit supervisor, who is a part-qualified chartered certified accountant, has sent you an email from which the following extract is taken. It's great to have you on board, as I was beginning to worry that there would be no manager review of our working papers prior to the financial audit clearance meeting next week. The audit assistant and myself have done our best to complete all of the audit work, but we only saw Rodney on the first day of audit about a month ago, when I think he was already feeling unwell. We had a short briefing meeting with him at which he told us, if in doubt, follow last year's working papers. One issue which I wanted to check with you is that Watson Company has introduced a cash-settled share-based payment scheme by granting its directors share application rights for the first time this year. This was not identified at the planning as a high-risk area. The SARs were granted on 1 July 2017, at which date the client obtained a valuation of rights which was performed by an external firm of valuers. I have filed a copy of the valuation report, and I have looked up the valuers online and have found very professional looking website which confirms that they know what they're doing. The cost of the SAR schemes based on the valuation is being appropriately recognized over a 3-year vesting period, and a straight line expense of $195,000 has been recognized in the statement of P&L on this basis. A corresponding equity reserve has also been correctly recognized on the statement of financial position. The amount also seems immaterial. And I can't see any need to propose any amendments to the financial statements in relation to either the amounts recognized or the disclosures made in the notes to financial statements. You have to comment on the quality of planning and performance of the audit of Watson Company, discussing the quality control and other professional issues. So I want you to just go through this and then we start. So what are the quality control and professional issue raised? The first one we have is fraudulent trading, right? Then reckless trading, then any civil wrong that is happening, and etc. You have to explain these points further. So what you have to say regarding fraudulent trading is that what is the definition of fraudulent trading? So fraudulent trading is defined by the Companies Act as carrying on the business of a company with the intent to defraud the creditors of the company or creditors of any other person. actions for fraudulent trading can be brought against any person who is knowingly a party to the fraudulent trading. So like that you have to explain every point and write. Then for the fraudulent trading, what is the penalty? That you have to mention. Then for reckless trading, again the meaning of reckless trading is that, and then civil wrong. So basically in this particular thing, you have to explain that. Okay, then what will you say about reckless trading? What is reckless trading defined as? Where an officer of the company is a party to carrying on the business of the company in a reckless manner, that is reckless trading. Then civil wrong is the burden of proof for reckless trading is the weaker test of the balance of probabilities, and you have to explain the threats to that reckless trading. Then implications for that reckless trading you have to explain. That is the part here. Okay, so that completes your mock. You have to write that in detail, only that much is left. So now we take a break of 5 minutes and then we'll continue further. Okay. Now the next we have is the other mock paper, which is a September-December sample question paper. So from this we are going to do the section B. This is the requirement of A part for 12 marks, and this is the B part for 8 marks. Then, so next question. So this is just like a practice mock. So they have like small questions and the marks are 20 and all, but we are going to do a proper 25 marker. This is also a 20 marker. But let's do it for practice, however. So I want you guys to read this question. Explain why each matter requires further investigation as a part of due diligence and review. This is what we have to do. So that we have to read the question. Please read the question. So consider this just for question practice, because this is not as per your paper pattern. So this is just for our practice, to give us a practice of further things. Explain why each matter requires further investigation as a part of the due diligence review. Recommend investigation procedures to be performed. For that, please read this. Till then, I'll quickly check the comments. So let's begin the same. We're doing section B. Recommend the investigation procedures to be performed. So this is going to be like a practice for threads, the various threads that we face. Okay. So let's read the question first. The requirement A says, in respect of the two matters identified above, explain why each matter requires further investigation. As a part of the due diligence, review and recommend the investigation procedures to be performed. So you are a manager in one of the assurance departments of Leopard and Company, a large firm of chartered certified accountants. You are currently assigned to a due diligence engagement for one of your audit clients, Cheetah Company, a manufacturer of bespoke furniture. The audit of Cheetah Company is conducted by a team from a different department. You have never been involved in the audit of this client. The engagement is to conduct a financial and operational due diligence review of Zebra Company, a company which has been identified as a potential acquisition target by Cheetah Company due to the synergies offered. What are the synergies offered? 1 plus 1 is equal to, say, 3, and the potential to expand the existing production facilities. As a part of the due diligence review, you have been asked to provide a valuation of Zebra Company's assets and liabilities and an analysis of the company's operating profit forecast. This will assist Cheetah Company in determining an appropriate purchase price for Zebra Company. During the engagement fieldwork, your team identified two matters which require your further consideration as follows. While reviewing correspondence with customers in relation to the outstanding receivables, one of the team found a letter from a large retailer for which Zebra Company produces a number of unique products, providing advanced notice that they are not renewing their purchase agreement with the current one expires. The customer advised that they are switching to a new entrant to the market who is substantially cheaper than Zebra Company. A brief analysis identified that the customer provides an average almost 5% of Zebra Company's annual revenue. Zebra Company owns a piece of land which was given to it as a gift by local authorities 10 years ago. The land surrounds the entrance to the main production premises and is designated as a nature reserve. Restrictions were imposed on the usage of land which also limit who the owner is able to sell the land to in the future. The land has zero carrying value in the financial statements. No additional matters have arisen for your consideration. You are also aware that the financial statements for the last 10 years have been audited and no modifications have been made to the auditor's opinion during this period. In respect of the two matters identified above, explain why each matter requires further investigation as a part of the due diligence. So, A, part 1, why is there a due diligence required? So, why the matters require further investigation. termination of contract, impact on forecast. That is the first point. The loss of the customer, may lead to reduction in forecast revenue by as much as 5% per year. This may also lead to a reduction in cost. Revenue will decrease also, but again cost will also decrease because there's a reduction, right? Specifically relevant to servicing the customer, right? For example, sales staff specifically allocated to servicing this client, right? And this is significant because the forecast future cash flows of Zebra company will be critical in determining the value of the company and the price offered by Cheetah company. It is therefore vital to establish all of the potential revenue and cost implications of the loss of the customer to ascertain the impact on the purchase price. Then wider implications of new competitor. If you remember, they are planning to switch to a new supplier. So new supplier is always your competition because it's a cheaper supplier. So the customer referred who has switched to a new cheaper supplier this may have wider implications if the new supplier is directly targeting the customers of Zebra company. it is probable that the customers may switch to the new supplier in the future because they're getting it cheaper. Which would have further implications on future revenue and cost forecast. It may not be possible to determine the potential impact of the new supplier, because how much it will affect you, it's not possible to determine at this point. Which increases the level of uncertainty associated with the potential acquisition. Cheetah Company may be able to use this uncertainty as a tool for bargaining with owners of Zebra Company over the final agreed price. Because still we do not know that how much the new supplier is charging. So we can use it as a tool because it's very much uncertain of how much they are charging. So instead, up to the time we know that how much they are charging, we can use it as a tool to bargain for the final agreed price. Then the next we have is possible impairment of other assets. The loss of major customer may be an indication of impairment of the assets of Zebra. That means the assets of Zebra have now become old, they've become impaired. This will be particularly relevant if Zebra Company holds specific assets for manufacturing the unique furniture products made for this client. As well as production assets Zebra Company may also be holding inventories which are specifically relevant to the customer which cannot be reused elsewhere or sold to other customers. If this is the case, these inventories will almost certainly be impaired. If not performed at the year end, it may now be appropriate to conduct an impairment review to ensure that the valuation of the assets as presented in the FS is still appropriate in the circumstances. Then next, now the second one, Zebra Company owns a piece of land which was given to it by a gift by local authorities 10 years ago. The land surrounds the entrance to the main production premises and is designed as a nature reserve. Restrictions were imposed on the usage of land which also limit who the owner is able to sell land to in the future. The land has zero carrying value in the financial statement. So regarding this, what will you say regarding the gifted land? Because we have to say about both the issues. So for gifted land, what will be the points? This was for termination of contract. Now for gifted land, possible restrictions on sale is what? The restrictions on the sale of land may mean that Zebra Company is prohibited from including the land as a part of acquisition by Cheetah Company it is likely that following acquisition Cheetah Company will not be able to initiate sale of the land to an external company or develop or change its current use. Because it's gifted also, na? This may act as a deal breaker if Cheetah Company is not able to obtain control over the land surrounding the entrance to the production facilities. If Zebra company is not prohibited or not permitted to include land as a part of the deal, with Cheetah company, then this may also have an impact on the purchase price as the owner of Zebra company may have attributed some value to the land, because how can it be a nil value in their expectation of the price which they can achieve. If so, it will be important to ascertain the value attributed to the land by the owner to negotiate the reduction of the purchase price. This is the possible restriction on sale. What is the second issue that we can think of? Possible limitation of future usage. Okay. If the land can be included as a part of acquisition deal, the restrictions may also mean that Cheetah company is not able to use the land for their intended purpose, such as the future expansion of production facilities, resulting in the acquisition of Zebra company not being an appropriate appropriate strategic fit for Cheetah Company if one of the key aims is future expansion. If this is the case, then this will severely limit the value of land to the company. Okay. If the land can be acquired but cannot be developed, it is likely that there will be ongoing maintenance cost because you can acquire it but you cannot develop it. And potentially other requirements and conditions regarding the upkeep of the nature reserve set out by the local authority. Which need to be understood as a part of the review. The cost of maintenance may result in a net annual cost of the business, and this needs to be quantified as part of the due diligence work. Right? This is due diligence. It will be vital, that is important, to ascertain what restrictions are in place, whether the directors of Cheetah Company believe they can extract any value from the use of the land. Based upon this, the directors of Cheetah Company may wish to try and negotiate the purchase of Zebra Company without the associated land, or they may wish to negotiate or lower price based on the restricted usage. Okay. And the last point, uncertainty regarding valuation. There is no valuation at all. Uncertainty regarding valuation. It may be difficult to accurately value the piece of land. The value attributed to it in the financial statement is zero, directly zero. So this may not provide an appropriate basis for estimating the resale value. A land valuation expert may be able to provide an estimation of the current market value of the land without restriction on its use. But they may find it difficult to accurately value how much it is worth because it's worth at zero. With the local restrictions. It may also be difficult to value the land based on the future cash flows attributable to it if it is not currently in use and its future usage is uncertain. As a result, the valuation of the land may become a point of significant negotiations between the directors of Cheetah Company and Zebra Company. This may also become a deal breaker if the two parties are unable to reach at an agreement Okay, so that's it with the first part of the question. That is for 12 marks. Now the B part. Before we do a B part, we'll take a break of 5 minutes. So let's resume. Comment on the ethical and professional issues raised and recommend any actions which should be taken in respect of the request from the management team of Cheetah Company. What is the issue? And it is for 8 marks. The management team of Cheetah Company has also approached Leopard and Company to ask whether representatives of the firm would be available to attend a meeting with the company's bankers, who they are hoping will finance the acquisition of Zebra Company, to support the management team in conveying the sustainability of the acquisition of Zebra Company for the meeting the bank requires the most up-to-date interim accounts of Cheetah Company with the accompanying auditor's independent interim review report. Your firm is due to complete the interim review shortly, and the management team of Cheetah Company has requested that the interim review is completed quickly so that it does not hold up the negotiations with the bank, stating that if it does, it may affect the outcome of the next audit tender, which is due to take place after the completion of this year's audit. Comment on ethical and professional issues raised and recommend any actions which should be taken in respect from the management team of Cheetah. So, ethical and professional issues. That is the B part. That is ethical and other professional issues. So the first ethical issue that I can think about is the advocacy threat. Being an advocate of the client. In this, accompanying the client to the meeting is obviously representing the client with their bankers will create an advocacy threat to objectivity, as Leopard and Company may be perceived to be representatives. Now this question is of 20 marks, so 5 marks are professional of Cheetah Company. This is particularly relevant as the bank may wish to establish a number of facts relating to the suitability of providing finance to Cheetah Company. Example, this may ask for representation that the company will continue as a going concern and that any forecast cash flows presented are accurate. Cheetah companies auditors these questions may be directed at the firm's representatives and the bank may take any response provided to their questions as assurance over these matters. Then first is advocacy thread, then is assuming management responsibility, Leopard company must also be careful that in providing services relating to the potential acquisition of Zebra company and the associated financing arrangements with the firm is not assuming management responsibility, although the terms of the engagement have not yet been confirmed. It is likely that by attending the meeting with the client, the audit firm will give the impression of supporting the acquisition of Zebra company and therefore give credit to the decision. Then what else can you say? The professional ethics code specifically states that the firm shall not assume management responsibility for an audit client as the threats created would be so significant that no safeguards would reduce the threats to an acceptable level. Then what else? Finance the acquisition, so that is the loan. The next one we have is loan transaction. Self-review threat, that is loan transaction. The code specifically states that providing assistance in financing rather finance raising transaction for audit clients also creates self-review threat to objectivity. The self-review threat arises where the outcome or consequences of a corporate finance service provided by the audit firm may be material to the financial statements under review. This is a particular problem as the transaction will directly affect the financial statements which the audit team will be responsible for auditing, and consequent financial periods, and therefore the audit team is likely to be more accepting of the information provided, or may not investigate issues as thoroughly as the team may feel that much of it has been done due diligence. Then they're also talking about the interim review, right? So interim review is also a self-review threat. Next one we have is again self-review threat, and in that we have the interim review. So what can you say for that? Reviewing the work of the team engaged in the interim financial statements would also create a self-review threat. Objectivity as the audit team will be reviewing the work of another team but within the same audit firm. So that is a self-review threat. It may be perceived externally that the purpose of reviewing the progress of the interim review is to ensure that any output from this does not impact the attempt by Cheetah to secure the loan finance. Then the next we can observe can be an intimidation threat. The request by Cheetah Company to ensure that the interim review does not impede the application for a loan may be perceived as intimidation by the client. It appears as though they are putting pressure if you observe on Leopard company to finish the work quickly, right? Finish the work based on the deadlines. Like do the work. So it is intimidation. So in that deadlines, they can make a lot of mistake. Closed by the bank. Rather than those originally agreed with the client. This may force the auditor into changing their approach. To any remaining procedures which would be considered to be undue influence of the client over the procedures performed. This appears to be supported by a further threat relating to the upcoming tender for the audit. The management team of Cheetah Company appears to be suggesting that failing to ensure the interim review is completed on time for the loan decision may have an adverse impact on any consequent tender bid. Okay. So this is the answer that we have for the B part. That completes the question. Now I want you all to quickly read this one and we'll see how much we can finish. Comment on the ethical and professional issues raised and recommend any actions that should be taken. For ASP company, first you read. It is worth 7 marks. Okay. Till then I'll quickly look at the comments. comment on the ethical and other professional issues raised, and recommend any actions which should be taken in respect of ASP, Viper, and Adder. Okay. You are a senior manager at Cobra and Company, a firm of chartered certified accountants. You are responsible for reviewing quality control and ethical matters which arise with the firm's portfolio of clients. During recent investigations, you identified the following matters. The first, company. ASP Company currently qualifies as a small company in the jurisdiction in which it operates, with turnover of $7.5 million, and last year the turnover was $5.3 million, and as such is not required by law to have an audit. Until recently, your firm has provided a range of non-audit services to ASP Company, including bookkeeping, payroll, and tax computation. Now tell me, can you provide non-audit services? No, because it becomes a self-review threat. The company recently obtained an offer for a significant amount of finance to help the company grow. The management of ASP Company has ambitious plans for growth, which they believe will result in revenue doubling within 1 year and then continuing to grow at a similar rate for at least the next 5 years. In order to secure the funding, the directors have decided to have the financial statements audited and have asked if Cobra and Company will become the company's auditors, as well as continuing to provide the existing services. So along with them being the auditors, they should continue to provide the current services that they are providing, including bookkeeping, payroll, and tax computation and advice. This will include auditing the financial statement for the year ended 31 July 2027 at the request of the new financiers. Do you think it is even possible? And what are the different threats that they are going to face? So before we begin that, I want you all to start writing the answer. So let's begin writing the answer. The first thread that I can at least see is the self-review thread, because they are providing the services. So this is the A part. Just give me 1 minute, okay? I'll just reply to a comment. Okay, so it's ASP company and it's a self-review threat. It's exactly same like we did the previous one. You have to just identify the threat. Okay, if Cobra company accepts the audit of ASP company and continues to provide the other services, this would create a self-review threat to objectivity. This would arise because of all other services would have an impact on the financial statements which Cobra and company would then be responsible for forming an opinion on, given the nature of the services, the impact on the FS would most likely be material. The professional ethics and conduct does not prohibit firms from providing bookkeeping and tax services to non-listed audit clients. But requires that sufficient safeguards are implemented to reduce any threat to an acceptable level. The response should be considered in light of the complexity of the other services and amount of judgment required in providing other services. This is the self-review threat. Then assuming management responsibility again. So what can you say in assuming management responsibility? Again the same point. Undertaking bookkeeping and taxation services on behalf client may require the service provider to make decisions on behalf of the client or may create the perception that the service provider is acting in a managerial capacity. If Cobra company were to assume management responsibility for an audit client, this would create a threat to their objectivity. Then what to do? Designating an individual who possesses suitable skills knowledge and experience to be responsible for the client's decision and to oversee the services being provided. Provision of oversight of the services and evaluation of the results of services performed for the client's purposes. Accepts responsibility for the actions to be taken as a result of the services. So this is what you can do if they start assuming management responsibility. Then what are the action that they have to take? Because now they are being offered audit also and they are being offered this also. So what actions to be taken? If Cobra company accepts the audit engagement, first of all, they will need to use separate staff to undertake the audit to those involved in the other services. Cobra and company must ensure that they have sufficient staff with the necessary competence within the firm to enact such segregation of duties and they must ensure that the client understands the different teams will be used in various services provided. Okay, so these are the actions that the company will take. Now some of the important points I wanted to tell you guys. First of all, we did one complete mock, and second mock we did like almost half of it. Okay, for your AAA, you need to know the concepts really well. So first of all, whatever concepts are there in the book, conceptually do it. On the first day of the lecture, I showed you guys how to study from the ACCA Study Hub. Go to the Study Hub, select your subject, AAA International. From that, do topic wise and solve the MCQs. I know although MCQs is not a part of your paper pattern, MCQs will tell you how conceptually clear you guys are. So once you do the MCQs, you know, okay, I'm conceptually clear. Then I want you all to solve a lot of section B and section A questions and at least 3 mocks before the exam. Please try to do the mocks and please get your mocks checked. Either self-mark them or get them checked from your tutor, because that is very important. When you're solving the mocks, I want you all to do timed mocks. So time mocks will give you an idea of how to work under the time pressure. So when you do a timed mock under the time pressure, you know, okay, for this question I have 1.5 hours, or for this question I have 30 minutes, and depending on that. Presentation is equally important. The reason being, typing entire answers is because you guys should know how important a presentation is, because from September 2022, the actual paper is going to be only of 80 marks. The remaining 20 marks is going to be professional. Okay, so that is very important to understand. Other than that, we have covered a lot of points in this quick revision revolution. I wish all you guys all the best. Those who are watching it, those who are watching it at the comfort of your time, those who are live, not live, all the best for your examination, and I'm sure you guys will come out with flying colors.